very reminiscent of what we saw in 2007, 2008. And I believe that when the equity markets do decline in the months ahead, as this turmoil continues, that the mining stocks value that there is there will still go down. And so I think there's something of a value trap right now. I'm having a hard time seeing them decouple from the larger equity market trend. So far, they just haven't been able to do that. I do believe that metal may well decouple, and I think that's the trade. I think you want to be long metal and avoid risk, because I think this time with the U.S. finances in question, that may really hold back the U.S. dollar as a flight to safety. I think most of the flight to safety this time is going to come into precious metals and, relatively speaking, hard currencies like the Swiss franc, like the Swedish kroner, like the Singapore dollar, the Taiwan dollar, and maybe the Canadian dollar. But I would be very, very careful at this stage of the cycle with the mining stocks.
All right. We'll leave it there, Frank. As always, I appreciate you coming on the program. Please come back and speak with us again.
Thanks so much, JP.
You're listening to the Financial Sense News Hour at financialsense.com.
Up and away, my beautiful balloon.
Inflation has picked up so far this year. The price index for personal consumption expenditures rose at an annual rate of more than 4% over the first 5 months of 2011 and 2.5% on a 12-month basis. Much of the acceleration was the result of higher prices for oil and other commodities and for imported goods. In addition, prices of motor vehicles increased sharply when supplies of new models were curtailed by part shortages associated with the earthquake in Japan. Most of the recent rise in inflation appears likely to be transitory, and FOMC participants expect inflation to subside in coming quarters to rates at or below the level of 2% or a bit less that participants view as consistent with our dual mandate of maximum employment and price stability. The central tendency of participants' forecast for the rate of increase in the PCE price index was 2.3 to 2.5% for 2011 as a whole, which implies a significant slowing of inflation in the second half of the year. In 2012 and 2013, the central tendency of the inflation forecast was 1.5 to 2%. Reasons to expect inflation to moderate include the apparent stabilization in the prices of oil and other commodities, which is already showing through to retail gasoline and food prices, the still substantial slack in U.S. labor and product markets, which has made it difficult for workers to obtain wage gains and for firms to pass through their higher costs, and the stability of longer-term inflation expectations as measured by surveys of households, the forecasts of professional private sector economists, and financial market indicators.
Up and away, my beautiful balloon.
Well, it would seem like everything started buzzing earlier this week when the latest Fed minutes were released. Now, remember, these were released something like 6 weeks after the Fed meeting happens, but they were released, and they were talking about more stimulus. And, that sounds a lot like quantitative easing. Then on Wednesday, Federal Reserve Chairman Ben Bernanke was before Congress, and I always wonder what kind of deodorant he's using, Jim, because he sure he sweats an awful lot, you know this.
Oh, especially when Ron Paul gets the gavel.
So anyway, and by the way, the Fed was stipulating that they were going to do more stimulus if they perceive the economy to be weakening. But then Wednesday, the chairman said, well, not that much more stimulus, blah, blah, blah. So you're getting sort of a mixed message here. But I guess the first thing we need to look at is the economy really weakening or not? And then could we anticipate some kind of Fed action?
Well, I mean, every single week we're getting further evidence. You know, they're calling it a soft patch. And if you listen to what the Fed was saying in his testimony this week, Bernanke was saying that this is a soft patch and it's temporary. And he based that on three facts. Number one, we had the events that occurred in the Middle East, which was disruptive to the markets, which led to higher oil prices. And then, of course, the earthquake in Japan. So he said, you know, higher food and oil prices are only temporary, and the backup in manufacturing problems in Japan, these are all temporary. And as a result, as these things get resolved, and therefore the chairman is saying that the second half of the year is going to be better than the first half of the year. Now, I think it's going to take a little printing press to run that, because if we report this to you, the listener, every single week, I've got a composite here of all the major indicators around the globe. But, I mean, if you take a look at the composite leading indicators for the OECD countries, it ticked down from 102.8 to 102.5, so it's been in a downtrend, as many of the other indicators have been since late March. If we take a look at Moody's Analytics survey of business confidence worldwide, that continues to fall. Consumer confidence continues to fall. The NFIB small business survey, that continues, that's sort of flattened out here recently. If we look at chain store sales, change from the previous week, that's looking a little better. The international trade deficit jumped to $50 billion. And John, it went from $43.6 billion to $50.2 billion. 2/3 of the deterioration came from rising oil prices. And I hate to tell the chairman, despite the little manipulation they did with margin requirements and releasing the strategic petroleum reserves, but on this Friday, the price of oil is at almost a little over $97 a barrel. So the U.S. is importing more oil. It's adding to our trade deficit. That's not good. Job openings ticked up recently. If we take a look at mortgage applications, they've gone down. The good news is import prices have gone down. But if we take a look at various other things, foreclosures, jobless claims went down this week. That's sort of a moving average. You got to look at the average over 4 or 5 week period of time, because it just jumps all over the place from week to week. Retail sales are very anemic. They've been heading down since middle of February. Consumer confidence is in no great shape. If we take a look at things like consumer price index, we mentioned that, a lot of this stuff was going to flow through. Consumer price index fell somewhat. It's only up 0.2% in June, and it was expected to decline. The New York Empire Manufacturing Survey Index is negative, but at least it ticked up. Of course, the one that we watch rather closely, industrial production, is starting to tick up, and this is what the chairman might be making reference to, the disruptions that were brought about because of the earthquake in Japan. But the ECRI weekly leading index at least has flattened. It's been falling steadily since the end of March, and now it's flattened for 2 weeks in a row. So the hope is, John, in Washington, that the disruptions in the Middle East, whether it was the Arab Spring, the current conflict going on in Libya, which led to higher oil prices, is temporary. Higher oil prices, they believe, is temporary, which I disagree. I think oil prices are heading up over $100 a barrel, no, maybe $150, as Barron's pointed out in its, about 2 weeks ago, the front cover. And then, of course, now that Japanese manufacturing is coming online, you would expect to see industrial production go up, and it has ticked up. So if we stay where we're at right now, it does show that the economy has softened considerably. And here's the thing, the budget numbers are going to get bigger, because if you take a look at the Obama budget projections, they're based on an economic growth rate of 3.5%. There is just no way the U.S. economy is going to grow at 3.5%. It grew at 1.8% in the first quarter, and we're probably around close to that in the second quarter. So we would have to see 4% economic growth rates in the third and fourth quarter. So I don't see that. So the economic numbers, John, tell me the economy is going to remain weak, and that's not good news for the guys in Washington, which is one reason that the Fed may be hinting at already that there's additional stimulus.
Well, like I said, Jim, how's the economy doing? You know what? In the light of all of this, watching the budget debate over the last 2 weeks and the claims and the counterclaims, not to mention the follow-up on the cable talk channels and talk radio, it really resembles kabuki theater. I kid you not. Because they're acting like something tremendous is going down there. They're acting like there are sacred cows that aren't going to be gored. And you and I both know that no matter how you slice it and dice it, the biggest part of the budget is social spending. That is going to have to be cut at some time or another. It's going to happen. But at the same time, the deficit is just soaring. And they're not even dealing with, a third of it.
No. And the other thing, if you basically take a look at, the Fed has been financing the majority of the budget deficit. We're tracking about 160, 170 billion. In fact, let me just go to government budget deficit numbers. The unified budget deficit was 43 billion in the latest month of June. Now, if you look at February, it was 225 billion. It was almost 180 billion in March. And the big months, and especially the kickoff, the budget deficit starts to increase as we get closer to the government's fiscal year, which ends in September. So we're already tracking between 1.5 trillion and 1.7 trillion. And of course, the weaker the economic growth is, the higher the budget deficit numbers go, the higher the unemployment rate goes. That means those are people that are now out of work collecting benefits and not paying taxes, so the higher the budget deficit numbers go. So we cannot afford, in this we commented last week, Lawrence Lindsay, former Fed governor and advisor to George W. Bush, did an op-ed piece in the Wall Street Journal. He goes, if interest rates were to go up 2 percentage points from where they are today, because the government's only paying 2.5% on all of its debt. I mean, right now, they're basically financing T-bills at almost zero. A 6-month T-bill is 4 basis points. A 3-month T-bill is 1 basis point. So they're basically getting money for free. But if interest rates were to normalize, and let's say we went from 2.5 to 4.5, the budget deficit would increase by 5 trillion, John. So that would be much bigger than any of the numbers they're talking about now. So there's no way the Fed is going to allow that. There's no way that Washington is going to allow that. There isn't enough money in the world to finance U.S. government spending, where 40 cents out of every dollar is financed. In the next couple of years, they're projecting it's going to be like 45, 46 cents out of every dollar. And you know, John, when they talk about budget deficits, they always do these savings over a 10, 12-year period. The president's talking about 12 years. It's all balderdash. They never cut, but it looks good. The spending cuts take place in the out years, and there's no way that this president or anybody is going to cut anybody's benefits before the 2012 elections. It's not going to happen. So we are going to go to QE, I don't know what they're going to call it. They're not going to call it QE3 because that has a bad stigma attached to it. But already you've had the Fed minutes indicate that if the economy weakens or unemployment goes up, there's going to be more stimulus. You had Bernanke before the House on Wednesday saying that if the economy weakens, there's going to be more stimulus. Now, the stock market took off. Gold is at a record high. And then the next day, he sort of modified that. Whoa. Nah, we're not ready yet. But believe me, I think what they're going to do is they're going to wait for the price indexes to soften somewhat, and we're seeing that. Producer prices are starting to slow down in their ascent. The CPI is starting to slow down in their ascent, and I've been watching the regional Fed price indexes, the price paid component, and that is now starting to soften. And I think they're going to wait a couple months when it begins to soften, and then we're going to get our next round of stimulus. I don't know what they'll call it. We're calling this segment, when is QE not a QE? And they'll probably call it the Stimulation Job Creation Monetary Higher Stock Price Act or something. I don't know what they're going to call it, but believe me, it's coming, and they're already hinting at that's coming. And remember, if you've been listening to this program, we've been talking about a concept called financial repression, where you keep interest rates artificially low and you inflate your way out of your debt problem. That's what the United States official policy was for 3 decades, basically inflating away the debt used to finance the Great Depression in World War II. And there have been a number of academic papers out there, from Carmen Reinhardt to many other people in academia. They're saying the way to get out of this is to run about a 5 to 6% annual inflation rate, and we can get this debt to a manageable level. So it is coming. And they gave a hint at, both sides are talking about reducing the way we measure the cost of living, or the CPI. They're saying we're overstating the cost of living, and CPI is overstated. Actually, we're really experiencing benign inflation in this country. Ignore what you pay at the gas pump. Ignore your utility bill, your health care premiums, your food bills, all the other stuff you have to pay. But, John, I can tell you QE 3, 4, 5,